Imagine waking up, grabbing your phone, and checking your investment portfolio while you're, still half asleep.
Yeah, worst way to start the day.
Right. You rub your eyes, convinced the screen is just glitching because you were staring at an absolute sea of red.
Just total panic.
Exactly.
Yeah.
An asset you own has just plummeted 10% overnight. And the drop is so severe, so incredibly violent, that it triggers the market's emergency circuit breakers. Not once, but twice.
Which is incredibly rare.
It is. And that exact scenario just played out across global and domestic exchanges. So welcome to the deep dive. Today we're separating the short-term market panic from a massive structural shift happening behind the scenes.
Because we need to answer one really crucial question. Did the precious metals bubble just burst, or is this simply a violent pit stop in a multi-decade supercycle?
Right. And it's the kind of morning that instantly spikes your blood pressure, right? I mean, circuit breakers are literally the market's emergency brakes.
Yeah, they're designed to halt trading when just pure panic takes over. And for an asset class to hit those limits repeatedly in a single session, especially an asset as old and established as silver, it means something has fundamentally fractured in the market psychology.
Yeah, we aren't talking about some obscure microcap tech stock here or like a volatile new cryptocurrency.
No, this is silver.
One of the oldest stores of value in human history. It had been on this seemingly unstoppable bull run and then suddenly just a frantic scramble for the exits. So let's unpack this.
We really need to.
Because when I look at the timeline of what just happened, it feels less like a natural market correction and more like, a pressure cooker that finally exploded.
That's actually a really good analogy for it.
The market had run up entirely too fast, driven largely by pure FOMO. The fear of missing out. People were rushing in simply because the line on the chart was going up.
Right. Pure speculation.
Yeah. And then the world's largest commodity exchanges, from Chicago to Shanghai, stepped in and essentially pulled the plug by hiking margin requirements.
Which is a mechanical trigger we really need to understand because, it explains the sheer violence of the drop.
Right, the actual mechanics of it.
Exactly. When exchanges like the CME or the MCX raise margin requirements, they are essentially demanding that traders put up significantly more of their own cash just to hold on to their speculative positions.
So they're changing the rules mid-game.
Basically, yeah. Let's say you are holding a massive silver position with only 10% down. Overnight, the exchange says, actually, we now need 20% down to hold this trade.
Wow, just out of nowhere.
Right. It's a deliberate mechanism to cool down an overheated, overcrowded market.
So if you're a trader who, doesn't have that extra cash lying around to meet the new requirement, what happens?
You have absolutely no choice. You are forced to sell.
Just immediately?
Immediately. Your broker will automatically liquidate your position to cover the risk. And when thousands of over-leveraged traders are forced to sell at the exact same moment...
It just cascades.
Exactly. That forced selling accelerates a downward price spiral. It triggers other people's stop losses, which forces even more selling. It effectively blows the speculative froth right off the top of the market in a matter of minutes.
So that explains the mechanical, immediate trigger on the trading floor. But global commodity markets don't just exist in a vacuum, right?
No, absolutely not.
There are always massive macroeconomic shifts happening in the background. And looking at the broader landscape in our sources today, it seems a few major geopolitical updates completely altered the mood in the room.
They did. You had this perfect cocktail of easing global tensions.
Right.
First, there was news of potential diplomatic talks between the U.S. and Iran taking place in Qatar.
Okay, so that's one big de-escalation.
Yep. And on top of that, there were positive virtual discussions between the U.S. and China.
Oh, right, involving agricultural trade, I think?
Yeah, specifically things like soybeans, as well as some highly sensitive discussions regarding Taiwan.
So global tensions are cooling off. And I imagine that completely removed the fear premium from the market.
It does. It drains it right out.
Because gold and silver are the classic safe haven assets. When the world feels dangerous and unpredictable, capital flees into those metals for safety.
Right. People buy it to protect themselves.
But when diplomacy offers a glimmer of stability, well, nobody wants to pay top dollar for a safe haven anymore.
That is precisely the dynamic. The immediate demand for those safe haven assets just evaporates. But diplomacy is really only half the storm here.
Okay, what's the other half?
The real hammer actually came from Washington, specifically regarding the U.S. Federal Reserve.
Ah, okay, let's get into the Fed, because the appointment of Kevin Warsh seems to be a massive signal.
It's a huge signal.
My first instinct when the market is panicking is that the Fed might, step in, slash interest rates and save the day, but his appointment signals the exact opposite, doesn't it?
It really does. Looking at Kevin Warsh's track record, he has historically been a staunch opponent of ultra-easing monetary policies.
So no easy money.
Exactly. He doesn't favor flooding the system with cheap money. And if we connect his appointment to the broader signals coming from current Fed officials, it paints a very clear picture.
Which is what, exactly?
They are prioritizing the fight against inflation over propping up a soft labor market. And that points strongly toward very limited, if any, interest rate cuts in the near future.
And let's connect the dots for the listener on why interest rates actually matter to a piece of muddle.
Good idea.
Limited rate cuts mean interest rates stay relatively high, and high interest rates make the U.S. dollar an attractive place to park your money.
Right, so the dollar gets stronger.
Exactly. And because commodities like gold and silver are priced globally in U.S. dollars, a stronger dollar instantly makes those metals more expensive.
And therefore much less attractive for any buyer using another currency around the world.
Right. Global demand drops and the price sells off. It is just a direct chain reaction.
It really is.
Which leads me to my biggest question, and it's something I really want to push back on here.
Right, let's hear it.
You've got the exchanges forcing massive liquidations, right?
Right.
You've got geopolitical fear dropping, and you've got the Fed keeping the dollar incredibly strong.
Yeah, massive headwinds.
Right, with all those massive headwinds. Is this double-digit price crash a fundamental failure of silver as an asset? Or is it just a temporary symptom of those over-leveraged traders getting wiped out?
Well, that is the essential question. And to answer it, we really have to look past the digital tickers flashing red on the screens.
Look at the real world, you mean?
Exactly. We have to examine what is actually happening with the physical metal, because there is a fascinating local regulatory drama unfolding in India right now.
Oh, yes, the import drama.
It is completely at odds with the global paper sell-off. It is actively threatening to squeeze the physical supply.
The details on this from the sources are just wild. So the nominated government agencies in India, the ones that hold the authority to import physical bullion, they have abruptly hit the pause button on physical gold imports.
Just stopped it entirely.
Yeah. But why would they do that right in the middle of a global price drop?
Well, they halted operations to rectify a highly specific tax loophole. Importers essentially found this clever accounting trick to sneak physical metal into the country.
Oh, wow. How are they doing that?
They were exploiting a dual bill system to import the metal under a discounted 5% concessional tax bracket.
Okay, so getting a huge discount.
Right. While simultaneously dodging a secondary 3% state tax, the Integrated Goods and Services Tax, or IGST.
So to stop the financial bleeding, the authorities just hit the emergency stop button on all imports.
Exactly. Just stopped everything while they tracked down the evaded taxes.
It's like a massive wholesale warehouse abruptly locking its front doors.
That's a great way to picture it.
I mean, the digital price of the metal on the global exchange is plummeting, but locally, the actual physical supply is trapped inside.
Right. It can't get to the buyers.
It reminds me of the stock price of an airline plummeting because of a broader Wall Street panic, even though every single flight they offer is completely sold out for the next 5 years.
Yeah, the ticker says sell, but the physical reality says we are packed.
So what happens to the demand if this tax enforcement becomes permanent? I mean, if it makes importing fundamentally more expensive.
It creates a massive bottleneck. If that temporary pause evolves into strict enforcement of that extra 3% tax, bringing physical metal across the border becomes inherently more expensive.
Right.
The paper price globally might be falling, but local physical demand from jewelers, manufacturers, and technology industries, that doesn't just vanish.
They still need the metal.
Exactly. If supply is choked by bureaucratic red tape, you often see local physical premiums detach completely from the global paper price.
Meaning buyers will pay significantly more than the quoted exchange rate.
Yes, just to get their hands on the actual metal. It proves that the appetite is still ravenous. It's just trapped behind a regulatory wall right now.
So we have this massive disconnect. The physical market is tangled in red tape, while the paper market is in a terrified freefall. With these massive double circuit breaker drops dominating the headlines, it is entirely natural for you, listening right now, to wonder if we are witnessing the catastrophic popping of a historical bubble.
It's what everyone is asking.
To really figure that out, we need to zoom way out. We need to look at the 100-year history of silver crashes that the researchers laid out in our sources today.
And it is quite a history.
I have to admit, looking at the historical data, it paints a terrifying picture.
History rarely repeats itself exactly, but it certainly rhymes. And silver has arguably the longest history of dramatic, violent price action of any major asset class.
Let's run through these historical ghosts because the numbers are just staggering.
They really are.
Going all the way back to the 1929 Great Depression, silver fell between 55 and 60% over 3 agonizing years.
A huge drop.
It dropped from 60 cents all the way down to 25 cents an ounce. Then jump forward to 1980. This is the famous Hunt Brothers saga.
That is the ultimate cautionary tale in commodities.
It really is.
The Hunt brothers didn't just buy silver. They bought paper contracts and then actually demanded physical delivery.
They wanted the actual bars.
Right. They were actively trying to corner and squeeze the entire global market. And they drove the price from around $6 all the way up to nearly $50.
But then the exchanges changed the rules, right? They raised the margin requirements.
Exactly like we just saw today.
Wow. And the whole thing completely unraveled. But that 1980 crash wasn't a slow bleed over 3 years, was it?
No, not at all.
The price plummeted a staggering 57%, from $49 down to $21 in just 2 months.
Just 2 months, it completely broke them.
That's insane.
And the cycle continued. In 2011, we saw another massive bubble pop, with prices falling 40% in just 6 to 8 months.
So on behalf of anyone holding this asset, I have to ask, is silver just a notoriously dangerous roller coaster?
It's a fair question.
Are we just riding the peak right before the next inevitable 50% plunge into the abyss?
Well, what's fascinating here is the broader context behind those historical crashes. If we look at the history of commodities as a whole, they are notorious for having relatively short, explosive bull markets.
Like maybe 2 to 5 years of rapid gains?
Yeah, exactly. But those peaks are historically followed by agonizingly long bear markets.
Right.
Take the period after the 1980 crash. We saw a 13-year stagnation from 1988 to 2001 where the price effectively did absolutely nothing.
A 13-year holding period just to break even.
Yeah.
That is brutal.
It is brutal. But the key difference lies in why those historical bubbles popped. In 1980 with the Hunt brothers, and again in 2011, the price was being driven almost entirely by financial speculation.
Just pure gambling on the price.
Exactly. People were buying paper silver simply because they thought they could sell it to someone else for more money tomorrow. It was a game at hot potato.
Oh, I see.
Historically, silver lacked a deep, irreplaceable, high-volume industrial utility to act as a permanent safety net under the price. Once the speculators got scared, there was no baseline industrial buyer to catch the falling knife.
Which brings us to the most critical pivot in this entire discussion.
Right.
If history proves that silver bubbles always end in tears, why do the researchers in the sources passionately argue that this time is actually different?
Because that phrase is usually a trap.
Yeah, this time is different is usually the most dangerous phrase in finance.
It usually is. But in this case, the underlying nature of the asset has fundamentally transformed. Silver is no longer just a financial asset or, a shiny monetary hedge against inflation.
It's an industrial material now.
It has evolved into a critical, irreplaceable industrial material. And right now, it is operating in a severe 6-year consecutive supply deficit.
Wait, a 6-year deficit?
Yes.
Meaning the world is literally consuming more silver than it pulls out of the ground year after year after year.
Exactly. And the data from the sources shows the numbers are massive. Last year, the global market was short roughly 200 million ounces.
Wow.
And this year, that deficit is projected to hit 300 million ounces.
Let me stop you right there because we really need to anchor that number to reality to understand the gravity of it.
Yeah, it's hard to visualize.
To put a 300 million ounce deficit in perspective, that represents a full 1/3 of total global silver production.
A full third.
If every single silver mine on Earth stopped operating today, we wouldn't have enough above-ground reserves to build a technology plan for the next few years. The green transition is essentially running on a massive overdraft fee.
That is a perfect way to look at it. The world is structurally running out of the metal required to meet its current industrial ambitions.
And here is where it gets really fascinating, because we have to highlight exactly what is eating up all this silver.
Right, where is it all going?
It's the backbone of new age technology. Let's start with electric vehicles.
Good place to start.
EVs went from representing just 3% of total vehicle sales in 2019 to roughly 23% today.
That's a huge jump.
And an EV requires significantly more silver for its complex electrical connections and battery management systems than a traditional combustion engine does.
Right, they're just packed with electronics. And the automotive sector is really just the warm-up act here.
Wait, really? Just the warm-up?
Yeah. The true behemoth emerging right now, consuming materials at a staggering rate, is the artificial intelligence boom.
Yes, the data centers.
Exactly.
Driven by the explosion of AI, data centers have seen a 5,300% growth metric. They're reaching roughly 5,000 global locations.
It's unprecedented.
And people don't realize this, but these massive computing centers require incredible amounts of highly conductive materials to manage power distribution and mitigate extreme heat.
Right, because they run so hot.
Yeah, and silver is literally the most conductive element on Earth. It has the lowest electrical resistance and the highest thermal conductivity.
You basically cannot build a hyper-efficient AI data center without it.
You just can't.
Coupled with the massive global mandates shifting energy grids towards solar panels, which are also heavily reliant on silver paste, the demand profile is entirely unstoppable.
This is coming from all sides.
Exactly. This is the new paradigm. And there is a highly memorable cultural metaphor from our sources that perfectly solidifies this shift.
Oh, I know the one you mean.
Yeah, they said, silver, worn on the feet for centuries, will now become a necklace.
Worn on the feet for centuries will now become a necklace. I absolutely love that.
It's great, right? It signifies the metal's permanent elevation in value, utility, and status. Because of this structural one-third of global production deficit, this isn't a one-year speculative rally that's going to crash back to zero.
It's structural.
Right. It is the beginning of a multi-decade story driven by unyielding industrial necessity, not just financial trading.
Okay, so if silver is riding this chaotic, highly volatile industrial wave, we have to look at its older, traditionally more stable sibling, right? How is gold handling this macroeconomic turbulence? Because gold also faced heavy selling pressure in this recent double circuit breaker panic.
It did, yeah.
So what does this all mean for the baseline value of gold, especially when we look at the ultimate foundational support for the gold market, which is central banks?
That is the perfect metric to examine. The latest data regarding central bank appetites from the World Gold Council is incredibly revealing.
Okay.
Now, at first glance, the headline number looks a bit bearish. Central bank buying actually dipped recently.
Wait, it went down.
Yeah, it dropped from 345 tons previously down to 328 tons.
But the entire narrative for the last 2 years has been that central banks are buying gold with both hands to diversify away from the US dollar.
Exactly.
If sovereign nations are slowing down their purchases, isn't that a massive red flag for the price?
Well, it is a completely valid concern, but it raises a really important point about institutional market behavior. Central banks are run by human beings. And just like you, they are highly price sensitive.
Of course. They don't want to overpay.
Exactly. After a historic run-up where central banks aggressively accumulated over 1,000 tons in a single year at much lower prices, they naturally hit the pause button when the price goes parabolic.
Ah, so they aren't abandoning gold, they're just experiencing sticker shock.
Precisely. They are waiting for the market to enter a consolidation phase. They want the price to establish a stable floor before they resume their heavy accumulation.
That makes total sense.
The key takeaway from the data isn't that the buying has stopped entirely. It has merely slowed down to digest the new higher price levels.
Right.
The foundational strategy of sovereign nations accumulating gold to protect their reserves, that remains completely intact.
And I think we can connect this directly to your own potential strategy as a listener. Whether you are looking at physical metals or ETFs or mining stocks, it is incredibly crucial to recognize the difference between a panicked FOMO sell-off and a healthy, necessary market consolidation.
It's a huge distinction.
The data suggests that for silver, the market is actively trying to establish a new fair average, somewhere around the $70 to $80 mark globally.
Right, because a market that goes straight up in a vertical line is inherently unstable. It's a speculative anomaly.
That's a bubble.
Yeah. When an asset runs up hundreds of percent in a matter of months, a 10 or 20% correction isn't a crash. It is the market inhaling.
Breathing out the speculators.
Exactly. It is establishing a foundation where industrial buyers can actually reliably forecast their supply chain costs.
Oh, that's a great point. If the price swings wildly every single day, solar panel manufacturers and AI companies, they can't plan their budgets.
Exactly. A stable, consolidated price around that new fair average is actually much healthier for long-term growth than wild speculative spikes.
So as we recap the journey of this deep dive today, we started with that terrifying image of waking up to a 10% plunge.
Circuit breakers triggering panic across the globe.
Yeah. But as we've unpacked the mechanisms behind the drop, it becomes incredibly clear that this sudden dip in gold and silver isn't necessarily the end of the grand bull run.
Far from it. The market is simply reacting to shifting U.S. Fed policies, the hawkish signals from Kevin Warsh, and, a temporary easing of geopolitical tensions.
Right.
It is digesting its rapid gains and forcefully shaking out the over-leveraged speculators through those exchange margin hikes.
But once the dust settles and that speculative froth is completely washed away, what is left behind is a market anchored by unyielding fundamentals.
Absolutely.
You have steady, ongoing central bank accumulation acting as a concrete floor for gold. And for silver, you have a massive, undeniable industrial deficit.
Driven by the relentless expansion of AI, green energy, and electric vehicles.
Exactly.
The structural realities of the global supply chain haven't changed one bit. Either the daily paper price took a hit on the trading floor.
Which brings us back to that circuit breaker and that initial morning panic. When the pressure cooker releases steam, it doesn't mean the stove is turned off.
No, not at all.
It just means the pressure is temporarily manageable again. But I want to leave you with a final lingering thought to explore on your own today.
Oh, this is a good one.
It's a scenario that builds on everything we've discussed today. And it is a scenario that could completely rewrite the rules of global commodity markets as we know them.
It really would change everything.
Given that silver is now utterly indispensable for the booming AI data center and green energy sectors, and given that we are operating at a staggering 300 million ounce global deficit,
Right.
what happens to the market if the massive tech and energy giants decide they can no longer rely on the open commodity exchanges?
That's the million-dollar question.
What happens to the available supply and the price if these multi-trillion-dollar companies decide to bypass the market entirely and begin directly buying up their own silver mines just to secure their supply chains?
It's definitely something to think about.
Something to think about the next time you check your portfolio.